Okay, let's dive right into this explainer. Today, we're totally rethinking how you view financial markets. We're going to debunk some of the biggest cliches out there about Wall Street by diving into Aaron Brown's incredibly insightful book, The Poker Face of Wall Street, along with the absolutely fascinating foreword provided by none other than Nassim Nicholas Taleb. If you've ever thought the stock market was just a giant roulette wheel, well, you're going to see things very differently by the end of this.
Here's our roadmap for today. We're going to move from high-level philosophy about the nature of risk, like the whole Wall Street casino myth and the Ludic fallacy, straight into the hard-hitting mechanics of stock trading. Let's get right into it. Section 1. The Wall Street casino myth, finance versus gambling. Let's start by systematically tearing down a universally recognized trope that you've probably heard a million times on the news or in casual conversation. To do this, we're combining Aaron Brown's really practical trading thesis with renowned risk philosopher Nassim Nicholas Taleb, who sets the stage perfectly in the book's foreword. It's deeply ingrained in our society to view gambling as unproductive and business risk as productive. But Brown's book completely flips this on its head. He suggests that the line between a highly skilled poker player and a successful Wall Street trader is essentially non-existent.
And this contrast is just brilliant. People love to say, oh, Wall Street is just a giant casino. But that is fundamentally wrong. Casinos operate on sterile, mathematically predictable odds. The house edge on a roulette wheel? That's a fixed, known entity. Wall Street, on the other hand, relies on human psychology, hidden information, bluffing, and true, messy uncertainty. So it's not roulette at all. It's a massive, high-stakes game of poker. Moving to Section 2, Taleb and the Ludic fallacy, the danger of games. Let's look at exactly why Nassim Taleb believes treating the market like a simple casino game isn't just wrong, but actually a really dangerous intellectual trap. So the crucial point to grasp here is what Taleb calls the Ludic fallacy. The word ludic actually comes from the Latin word for game. This fallacy is our flawed human tendency to take neat, clean probabilities from casino games and just map them onto the messy, chaotic reality of the real world. In a game, the rules are given, right? The odds are knowable. But in the real economy, the rules are constantly changing, and the true risks are entirely unquantifiable. There's this fantastic anecdote in the source material that hits the nail on the head. Taleb admits it drove him absolutely furious when graphic designers would put pictures of dice on the covers of his books about risk and probability. Why? Because rolling dice represents what he calls sterile randomness. A die has 6 sides, so the probability is neatly contained. Real-world economic risk doesn't just have 6 sides, it's wild, unpredictable, and completely uncontained. As Aaron Brown argues, once we realize we aren't playing a sterile game of dice with known odds, our entire perspective has to shift. We start to understand that our goal shouldn't be to avoid risk entirely, because in a truly uncertain world, that's literally impossible. Instead, the real key to success is learning how to manage that unknown effectively.
And that brings us perfectly to Section 3. Embracing unquantifiable risk and the history of speculation. Let's explore how embracing this specific type of unquantifiable risk has historically been the true driver of economic success and growth.
Historically, you can trace a really fascinating psychological evolution. Back in the 17th century Netherlands, the traditional middle-class mindset was built almost entirely around avoiding risk, seeking safe, predictable, conventional lives. But contrast that with the 19th century American West. Prospectors and pioneers consciously accepted massive, unquantifiable risks for a shot at incredible wealth. Modern financial markets, especially over the last few decades, are the direct descendants of that pioneer mindset. They've just created sophisticated models to harness and manage that wild risk.
Now, what's really interesting here is how Brown separates finance from simple gambling. Sure, they both involve risk, but finance generally offers a positive expected value over time. It's not like a slot machine that's quite literally designed to slowly drain your wallet. Plus, finance serves a crucial economic purpose, allocating capital to where it's most needed, whereas a casino is purely entertainment. But the biggest difference? On Wall Street, your opponent isn't a program machine. You are playing against other human market actors.
Let's get into the practical side of things with Section 4, 4 Rules for Risk, based on Aaron Brown's strategy. We're going to unpack his highly actionable principles for managing this real-world risk.
Brown lays out these 4 fundamental principles, and what's so brilliant is that they apply just as much to sitting at a high-stakes Texas Hold'em table as they do to navigating a bustling trading floor. You have to do your homework, play to win, know when to fold, and always have a plan B. Let's break these down one by one and see how they actually function in practice. Rule 1 is straightforward, but it is absolutely crucial. You must do your homework. You cannot use the existence of unquantifiable risk as an excuse to be lazy. You have to exhaust all available data, calculate every mathematical edge possible, and gather every piece of intelligence before you take the leap into the unquantifiable void. Basically, calculate what can be calculated first. Instinct only works after the math is done.
For Rule 2, play to win, Brown leans on this classic quote from the 19th century speculator Dixon Watts: "Prudence in contemplation, courage in execution." It means that during the planning phase, you've got to be exceptionally careful and prudent. But once you decide to act, you have to act decisively and with courage. Your goal isn't just to meekly minimize your failure, your goal is to maximize your success when you know you have the edge.
Rule 3 is a brutal psychological truth: knowing when to fold. In trading, they have a saying: the first loss is the smallest loss. When the situation changes, or when you realize your thesis is just plain wrong, you have to cut your losses immediately. Hoping things will magically turn around, that is exactly how traders blow up their entire accounts. Accepting a small initial loss acts as your ultimate protective shield. And that leads perfectly into Rule 4: always have a plan B. You must protect your inner capital, your character, and your resilience so you can live to trade another day.
Finally, we arrive at Section 5, the mechanics of speculation and how prices actually move. This is where we ground all this philosophy into the harsh mechanical reality of the market and where the poker analogy truly comes to life.
To illustrate this, Brown provides a brilliant theoretical scenario in the book. Imagine a completely calm, quiet market. We have a stock resting at exactly $25 a share. The fundamentals are completely stable, there's no breaking news, and absolutely no new economic data has been released.
Now watch how this builds into a chaotic chain reaction. First, for whatever random reason, the price dips slightly to $24. But that minor dip accidentally triggers a massive block of automated stop-loss sell orders that were just waiting at $23.75. That sudden flood of selling creates a cascade, forcing the price rapidly down to $22. Seeing this huge artificial drop, other traders rush in to buy the dip. The price snaps back up so violently that it blows right past the original $25 mark, hitting automated stop-buy orders waiting at $27. And that fuels a buying surge that rockets the final price all the way up to $28.
This scenario proves something truly incredible. That massive, violent price swing from $25 down to $22 and all the way up to $28 had absolutely nothing to do with the fundamental economics of the company. It's not like the company became less valuable and then suddenly more valuable in a matter of minutes. This wild ride was purely a result of market mechanics, order flows, and traders essentially playing the other players at the table.
The absolute most important takeaway you should grasp here is that Wall Street isn't a passive thermometer just measuring corporate profits, and it is definitely not a casino of pure random chance. It is a deeply psychological poker game. It's a living ecosystem of order flows, human behavior, panic, and greed. Understanding the mechanics of your opponents, rather than just the fundamentals of the cards, is how you actually win the game.
So I want to leave you with this final provocative thought from Aaron Brown's thesis to consider for your own life and investments. The conventional path teaches us to avoid risk at all costs. But true growth, both historically and financially, requires us to step out of that comfort zone. Are you just trying to minimize risk to stay safe, or are you truly ready to embrace the unquantifiable and learn how to actually manage it? Thanks for joining me on this explainer, and I really hope this changes how you view the incredible, chaotic game of the financial markets.